Okay, let's dive right into this explainer by confronting what is arguably the single biggest trap in investing, looking only at raw returns. It's incredibly common to pull up an asset, see a massive percentage gain, and immediately think, wow, I need to put my money exactly there. But today, we're going to learn why that instinct is fundamentally flawed and how the pros actually measure a portfolio's success.
Imagine you're choosing between two ETFs. They both sound great, right? On the surface, it seems like a no-brainer. Just pick the one with the bigger number. But to really spot the trap here, we've got to look a lot closer at the actual journey they took to hit those numbers.
Let's say Fund A boasts a massive 15% return, while Fund B sits at 10%. Fund A feels like the absolute obvious winner. Well, the plot twist here is the drastic difference in volatility, or what we call standard deviation. Fund A is riding an 8% standard deviation, meaning its price is swinging wildly up and down. Fund B, on the other hand, only has a 4% standard deviation. It's a much smoother, steadier ride. So which one is actually the smarter place for your hard-earned cash?
To figure that out, we're going to peel back the onion on the golden industry standard for measuring risk, the Sharpe ratio. We'll quickly cover the return trap, introduce the ratio itself, break down the actual math, grade the scores, expose some of its hidden flaws, and then look at some advanced alternatives.
All right, part one, the return-only investment trap. We really need to stop chasing returns without measuring risk. Let's unpack exactly why fixating only on high numbers can be incredibly dangerous when the market eventually takes a turn. Think about it. If an investment gives you 20% returns but acts like an absolute roller coaster, that excess risk might not actually be worth the potential reward. When we only focus on the final destination, we completely ignore the terrifying drops along the way. Without measuring risk, you might end up panic selling at the very bottom of a massive swing. And just like that, a theoretically high-return investment turns into a very real, very painful loss of your actual principal.
Which brings us right to our solution. This is easily one of the most widely used fundamental analysis tools in all of finance. Part 2. Introducing the Sharpe ratio, the ultimate metric to evaluate true performance.
Simply put, the Sharpe ratio tells you if you're actually getting adequately paid for the stomach-churning volatility you're enduring. It isolates the excess return you're making and compares it directly against the total risk you took to get there. Think of it as the ultimate lie detector test for your investment performance. Did your fund manager actually make smart, calculated decisions, or did they just take massive, reckless bets and happen to get lucky?
Tracing its history back a bit, this metric was created in 1966 by Nobel laureate William F. Sharpe. It originally started as a theoretical forecasting tool, what we'd call an ex-ante tool, but it eventually evolved into a historical evaluation standard. Now, it hasn't been without its fair share of controversy. In 1978, academic Richard Roll proved you could get entirely different results just by tweaking the benchmark. And by 1994, Sharpe himself actually had to update his guidance. He advised analysts to use short-term, monthly periods before annualizing the data, specifically to avoid compounding effects that can seriously distort the ratio.
So let's get into the math and see how this all builds into a beautifully simple formula. Part 3. Calculating the math step by step.
The calculation is surprisingly straightforward. Step 1, you just take your expected or historical portfolio return. Step 2, subtract the risk-free rate. This is usually the return of a US Treasury bill. It's basically asking the question, what could I have earned by taking literally zero risk? That leaves you with your excess return. Then, step 3, you take that excess return and divide the whole thing by your portfolio's standard deviation, which, as we know, represents your total volatility.
And this formula brilliantly solves our opening dilemma. Let's assume the risk-free rate is 3%. For Fund A, we take its 15% return, subtract 3, leaving us with 12. Divide that by its wild 8% volatility, and Fund A gets a Sharpe ratio of 1.5. But what about Fund B? We take its 10% return, subtract 3, giving us 7. Divide that by its exceptionally low 4% volatility, and Fund B scores a 1.75. So mathematically, it proves the lower return fund was actually the far superior risk-adjusted choice. Pretty cool, right?
Now that we have this magic number, what do we actually do with it? Part 4. Grading the ratio scores to see exactly what makes a good Sharpe ratio. The absolute crucial point here is knowing how to grade the number the formula spits out. Basically, anything less than 1.0 is considered suboptimal, meaning you are definitely not getting compensated enough for your risk. A score between 1.0 and 1.99, that's the sweet spot for most solid investments. We consider that good.
Between 2.0 and 2.99 is very good, and anything greater than 3.0 is practically excellent. At the end of the day, you're always aiming for higher numbers to ensure your returns are highly efficient relative to the bumpiness of the ride. However, you've got to be careful here. An abnormally high score, especially anything hovering way above 2.0, might actually be a red flag. It could indicate that the fund manager is using dangerous leverage to artificially amplify their gains. Because the Sharpe ratio alone doesn't explicitly reveal if borrowed money is being used, a score that looks totally too good to be true absolutely warrants a serious deep dive into the fund's prospectus. Remember, leverage amplifies gains, but it absolutely catastrophically amplifies losses too.
Which transitions us perfectly into Part 5, Limitations and Hidden Flaws, why the Sharpe ratio is not a silver bullet. Because, just when you think you've found the ultimate investment cheat code, you really need to understand its blind spots.
The most glaring issue here is that the Sharpe ratio treats all market volatility exactly the same. It literally penalizes upside volatility. That means sudden massive gains actually hurt your score just as much as sudden massive losses. On top of that, it assumes portfolio returns fall on a perfectly normal, symmetrical, bell-shaped curve, which anyone who's ever looked at the stock market knows it rarely does. It also fails to account for how long a fund has actually been running, and, as we touched on earlier, it can be sneakily manipulated simply by lengthening the measurement periods to artificially smooth out the appearance of volatility.
So to combat those specific flaws, the financial industry developed some pretty clever advanced variations. Let's hit Part 6, Beyond the Basic Sharpe and Upgrading Your Risk Management Toolkit.
Let's say you have a strategy that aims for huge upside bursts but strictly limits downside losses. The basic Sharpe ratio is actually going to grade you poorly for those upside bursts. In this specific case, the Sortino ratio is a vastly superior tool. The Sortino ratio tweaks the math so it evaluates excess return against only downside deviation. It completely ignores positive volatility. So if your asset suddenly spikes upward, the Sortino ratio essentially says, hey, great, that's exactly what we want, and it only punishes the downside pain.
Another fantastic tool is the rolling Sharpe ratio. A single Sharpe ratio just gives you one static snapshot, say a 5-year period, but that might hide the fact that a fund had one absolutely incredible year, followed by 4 terrible ones. Using a rolling Sharpe ratio breaks the timeline up into smaller moving windows, like a 12-month rolling window over a 5-year span. This turns a static snapshot into a moving picture. It lets you easily spot trends to verify if a fund is genuinely stable year after year, or if they just got incredibly lucky that one time.
So, as we wrap up this explainer and you go review your own portfolio today, I want to leave you with a final, slightly provocative thought about your true investment performance. Are your returns a product of calculated, highly efficient strategies, or are you just riding a wild wave of excessive risk that could literally wipe you out tomorrow? Take the time to apply the Sharpe and Sortino ratios to your own holdings. Stop chasing raw returns, start demanding risk-adjusted excellence, and really take control of your financial journey.